obvious. And so what I think will happen is the government will be forced into what I call yield curve control, which is another round of quantitative easing, which is really just complicated words for saying they're going to hit the button on the computer that says print more money. And that's fine. It'll keep the system going. But that's what they did in the COVID example when they grew money supply 40% in 2 years. And that's why everybody, when, I don't know about you, but when I go to the grocery store, I get horrified. I mean, you know, the cost of groceries is just insane. I mean, it went up so much in the last 3, 4 years. It's been horrible. And so, and so I think we've got more of that in our future, sadly.
Hey guys, welcome to Everyday Finance. More than just a speculative rally, Bitcoin's recent breakout to all-time highs represents a growing shift in investor sentiment around the world, driven by deep structural forces. The move highlights a larger macroeconomic story that is developing, going beyond short-term catalysts like ETF inflows. The rise of Bitcoin, according to seasoned investment manager Lawrence Lepard, who focuses on sound money principles, is a logical response to unsustainable fiscal policies and the decline in confidence in fiat currencies. Real yields are still negative, and inflation seems to be permanent rather than temporary as long as governments around the world continue to run significant deficits and fund them through money creation. Because of this, investors are increasingly using decentralized, scarce assets like Bitcoin as a hedge against systemic financial risk as well as inflation. From fiat-based, centrally controlled assets to hard assets with a fixed supply and decentralized control, Leopard sees this as a generational reallocation of capital. He suggests that the repricing of financial assets is just getting started by comparing this transition to past monetary shifts. Therefore, Bitcoin is more than just a trade. It is a fundamental tenet of the new financial paradigm, one that has the potential to change bond market dynamics, reshape portfolio strategies, and redefine the idea of value preservation in the years to come.
Well, a lot of reasons. I mean, the biggest picture, I think, is just continual monetary debasement. That's kind of, the book describes this as kind of just baked in the cake. This is Lynn's model, and it's been my model as well, that when you're expanding debt and you're expanding the monetary base more quickly than you're expanding GDP, that's an inflationary thing. And, Bitcoin is fixed algorithmically to 21 million coins, so it will not expand as all these other monetary base expand. So in dollar terms, Bitcoin, I'm with Sailor. Bitcoin is going much, much higher. It's going to multiple millions of dollars per coin over, the next 10 to 15 years. So I'd say but to point to the biggest cause is because the fiat system and the Keynesian model really just kind of requires continued inflation. And there was a time when that was, calmer and people weren't paying attention to it, like the 80s, after we had the gold rush in the 70s, and then Volcker got things under control. And, most people weren't paying attention to sound money during the 80s. But, it's gotten steadily worse, this issue of government spending and debt. And I think now we're kind of at the point where the pot is really on the boil. It's happening very quickly now. And as we all know, we hit a record high price today, 109, and I see us going to 140 or 150 this year pretty easily, and potentially higher. But I'm very comfortable predicting that.
And show the book if you would. I have mine
Oh,
ordered.
sure, yeah, happy to. So the
Link
book,
down below.
what's that? Yeah, the book is available on Amazon. It's hardcover, paperback, EPUB, Kindle, and audiobook. So. Yeah, anyone wants to pick it up there, you can. I'm also going to be at Las Vegas and at Prague, and have tables to do book signings at both those. You can purchase it there. But sadly, I didn't get thousands of books. I got hundreds of books. So once I'm out, I'm out. Yeah, well, I think the trade wars actually kind of feed into all of this. I think all of the economic problems that are bubbling up all over the place, including the Japan bond market, which appears to be kind of in a state of falling apart. I think all of these feed Bitcoin. The Bitcoin the price used to be correlated with the S&P, or I'm sorry, with the triple Qs and the Nasdaq, because it was kind of viewed as a risk on asset. I think we're in the process of seeing that change. I think it's now starting to trade more like digital gold. And what's going on is these two assets are really beginning to realize that the government is in a trap. that they just cannot stop printing money to keep the system running. And once that becomes widely known and understood, we'll have kind of what I call and describe in the book as a mass scale Gresham's Law-like event where people want to get out of other assets, particularly bonds that are denominated in a fiat currency, and get into the two currencies that the government can't print, which are gold and Bitcoin. And I prefer Bitcoin to gold because it's got an adoption cycle and it's got so many advantages over gold. But I don't shit on gold. Gold's got merit. It got us all the way to 2008, and it's not going to disappear overnight. It'll still do a job of protecting some of your purchasing power, but Bitcoin's a much better choice. Oh, sure. So Gresham's Law, Sir Thomas Gresham was a guy who was an advisor to Queen Elizabeth back in the 1500s. And what he said is, and so the issue of monetary debasement, this isn't new, right? This has been around for thousands of years. People have cheated on the money. The Romans clipped coins and sovereigns clipped coins and everybody, the denarius, which is the Roman form of coin, was started off all silver. By the end, it was all iron. Um, and Gresham's Law says that people can figure out when the money is going bad, i.e., if that kind of debasement is taking place, the average human being will look at the money that they know is losing value, in other words, where prices are going up in that money, and say, and then they'll look at another form of money maybe that's not losing value, let's say an ounce of gold, and the price of something in an ounce of gold won't be moving at all, and they'll say, huh, I get it. This one form of money is losing value, this other form of money is holding value. I'm going to spend the one that's losing value because why wait around for it to lose more value? And I'm going to hold on to the one that holds its value, which is gold. And so the law itself is written down as good money drives, or bad money drives out good. And what that means is that if the money is going, if one form, and there are always a couple forms of money going around in any economy, if one form of money is going bad, i.e., being debased, that will cause people to hoard the good money and spend the bad money. So, and at the extreme, like in Weimar Germany in 1921 through 23, they literally, throw out, the bad money and use wheelbarrows with which, because the printing presses were running so hot to purchase things, and they hang on to the good money, which in that time was gold or the dollar or the British pound.
Both gold and Bitcoin are reaching all-time highs, but the market is sending a far more somber message beneath these price swings. Lawrence Lepard, an investment strategist, sees this concurrent increase in hard assets as a warning sign rather than a normal bullish cycle. He contends that investors are becoming more aware of the structural flaws in the global financial system, particularly the unmanageable debt levels, the extremely low real interest rates, and the eroding capacity of central banks to use monetary intervention to stabilize economies. Lepard claims that these changes in gold and Bitcoin are precursors to a much more significant revaluation of money in general. Markets are starting to show that the trust that once supported fiat currencies is being called into question. Lepard advises investors to keep an eye on important macro indicators, particularly the quiet breakout of gold, long-dated bond distortions, and other disruptions in conventional financial instruments. He claims that these are indicators that the financial system might be on the verge of collapse, rather than merely statistics. Lepard thinks more intervention is likely as central banks face the limitations of their tools, and the reaction may lead to even larger capital flows into hard, scarce assets. According to this perspective, the emergence of Bitcoin marks the start of a more significant change in the way value is safeguarded and stored in a monetary environment that is becoming more and more unstable.
Yeah, so it's a great question. I think probably the most important macro indicator, well, there are four or five of them, but the price of gold. Notice it's hitting all-time record highs. A lot of people think, oh, it's just a bubble, it's going to come back down. No, it's not. It's going to go to 4,000, 5,000, ultimately 10,000 plus. The price of Bitcoin, same story. A few years ago it was 15,000, now it's at 109. I think it's going to 200, 400, 600 over time. The bond market, the long bond market, which tells you how much people trust that government bonds will hold their purchasing power. And what you're seeing there is in Japan, the 40-year bond is hitting record levels. In the United States, the 20-year bond just crossed the 5% mark, which is a big deal. And then probably finally, I would say, the stock market. The stock market's a little bit trickier to figure out, but it gives you a sense of how much liquidity is sloshing around in the system. And what I think is going to happen here is I think ultimately the stock market is going to start to go down. The U.S. bond market is already in the process of going down. Rates are going to go higher. And the government, the U.S. government really cannot handle higher interest rates. I mean, we are currently spending about $1.2 trillion a year on interest in the U.S. It's bigger than the defense budget. It's approaching the Social Security budget. And if interest rates keep going up, the government's going to, go bankrupt. I mean, they already are bankrupt, but it's going to be worse and obvious. And so what I think will happen is the government will be forced into what I call yield curve control, which is another round of quantitative easing, which is really just complicated words for saying they're going to hit the button on the computer that says print more money. And that's fine. It'll keep the system going. But that's what they did in the COVID example when they grew money supply 40% in 2 years. And that's why everybody went, I don't know about you, but when I go to the grocery store, I get horrified. I mean, you know, the cost of groceries is just insane. I mean, it went up so much in the last 3, 4 years. It's been horrible. And so, and so I think we've got more of that in our future, sadly. I
It's
think that's
crazy.
right. I think it is the most asymmetric bet out there. And one of the things I love about it, I mean, I made my career as a professional investor trying to find companies and bet on companies. And I can tell you that what's hard about doing that is that companies are run by people and people make mistakes. And, one of the things that's really beautiful about this as an investment is that it's a mathematical algorithm that just kind of keeps ticking along. It really doesn't depend on a management team. Not entirely true because you've got core developers around the edges, playing around with stuff. But because everyone's got to vote on changes and we're pretty well down the road, I think the risk of a problem arising with it are pretty low. And I just love the fact that it's got this asymmetry, and yet there's no management team to mess it up. You know, I think it's a really good thing. Look, buying a stable coin isn't any different than buying fiat, right? I mean, because it's denominated in dollars, the dollar loses purchasing power, your stable coin loses purchasing power. But what it does is it brings a lot more people, a lot of altcoin people, and a lot of other people into the tent, and it allows people to be thinking about crypto rails as ways of making payment. And that's a really good thing because, right now, I mean, the existing payment system is antiquated. It's based on Swift, it's bank to bank, and, it's got all kinds of problems. And there's no way in the digital world we live in, we shouldn't be suffering through this antiquated system. To have, stable coins and stable coin payments makes complete and total sense. So I get all that. The other thing is actually from a U.S. government point of view, and by the way, I'm sure that Trump and Bessent and others know this and are focused on this. Stablecoin companies, Tether, etc., are some of the largest, or if not, well, they're one of the largest purchasers of Treasury bills because they take cash in, they use that cash to buy Treasury bills, they issue a stablecoin that's supported by the Treasury bills, and so in a government that needs continual, Treasury bill issuance, to see the value of Bitcoin grow and to see stablecoin use grow, that actually helps them. They actually want to have that happen. Now, what they don't realize kind of in the back door is that eventually the dollar is kind of, we're attacking the dollar, but we don't have to tell them that. We can just we can just say, hey, look, we're going to help you we're going to buy some of your debt. Don't you want to support us? Yeah, okay, great. And I suspect that's how they got it through Congress. So, on balance, it's all good because I think that to get more and more people aware and into the microcosm or the system of, electronic payments, that's a good thing.
The recent spike in the price of gold and Bitcoin is not merely another speculative rally. Rather, it is an obvious indication that the world's financial markets are reacting to long-standing structural problems. According to Lawrence Lepard, the system is approaching a point where monetary expansion is unavoidable due to rising government debt, rising interest obligations, and dwindling central bank policy options. The robust and steady inflows into cryptocurrency exchange trade funds, ETFs, show that investors are acting proactively as they anticipate future developments. Bitcoin ETFs saw net inflows for 9 straight days, bringing in almost $385 million in a single session, despite the Memorial Day holiday. While Bitwise's BITB, VanEck's HODL, and Grayscale's Mini Trust all saw robust activity, BlackRock's IBIT ETF led the field and solidified its position as the institutional gateway to Bitcoin exposure. The overall net assets increased to almost $133 billion, while the total value traded jumped to $3.9 billion. Major companies like BlackRock and Fidelity are leading the way in Ether ETF inflows, which have been increasing for 6 days in a row. These flows show a strategic shift by serious investors getting ready for a monetary environment that will probably involve renewed stimulus and intervention, rather than just chasing returns. The trend is clear. The shift towards sound money alternatives like Bitcoin and Ethereum is accelerating, whether it is demonstrated by tightening bond markets, rising gold prices, or active ETF activity. Whether or not central banks take action, the financial industry is already preparing for a new phase, as evidenced by the capital flows.